Good afternoon and welcome everyone to a kickoff of our new trading summit on leveling up your options trading. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and this is session number 1 of 4, where we are starting out at the very beginning of the foundations of options trading, talking about buying versus selling options, the core strategies that's going to make up the strategy driver of any type of option strategy you trade. No matter how simple or complex, your strategy is going to be driven off of one of the 4 foundational option strategies that we will review during today's session. This is a session that is equally useful for beginners and for those of you that have experience trading options to review and make sure you understand the fundamentals of these types of strategies before you go ahead and embark on trading more complex strategies. This way, when you do trade more complex strategies, you have a better understanding of them, a better grasp of how they work. And then as we get into more advanced strategies into session 3, we'll also be able to discuss kind of what are the trade-offs you're making when you trade these complex strategies, whether those trade-offs are worth it or not, and kind of what that complexity adds to your overall trading, whether it's a net benefit or a net either the pros and cons, and making sure that you understand that. But before you can dive into that, you have to understand the fundamentals, and that's what we're here to discuss today. And just a reminder, the OptionsPlay education team, Jessica and I, we're focused on making sure that we empower you to trade sustainably and confidently. That means that you understand the strategies that you're deploying. You have an understanding as to why you're trading specific strategies, why you're trading specific ideas, and how to go about managing them effectively. Those are all things that we are going to discuss during this trading summit to make sure that you have the knowledge to trade options effectively, and more importantly, that you can sustainably grow your account with confidence using these types of strategies. And I see so many of you already chiming into the chat window saying hello and showing us where you are from. If you are joining us for the first time here at OptionsPlay, please chime into the chat window. Let us know where you're joining from. I see a lot of attendees from all over the world, South Africa. Looks like we've got quite a few from Germany, obviously plenty in the US and Canada, Brazil. Welcome, Peru. So welcome. I hope that you guys find this trading summit useful in helping you, empower you to become a successful options trader. Now, before we jump into it, what we are going to discuss today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So let's take a look at what the agenda is going to entail. First, we want to talk a little bit about the difference between stocks versus options. To understand the fundamentals of these 4 building blocks, you have to understand what stocks give you and what options give you. Stocks give you symmetrical exposure, options give you asymmetrical exposure. We're going to talk about what that actually means. Then I'm going to break down the 4 basic strategies: buying calls, buying puts, selling calls, selling puts. We're going to important to understand the difference between buying versus selling options for calls and puts. And we're going to break this down into 2 strategies at a time: bullish strategies, buying calls and selling puts, and then bearish strategies, buying puts and selling calls. Now, these 2 sets of strategies are fairly mirror images of each other. So once you understand the first 2, the second 2 become much easier to understand. And I'm trying to break it down into smaller and smaller chunks so that you have a clear understanding as to how you can progress from whether you're brand new to options trading and you're learning this for the first time, or if you're an experienced options trader and you want to get a better understanding of the strategies so that you have better confidence in the overall strategies. In the very end, I have a cheat sheet to help you review and just know kind of at any one point what the strategy driver of your strategy is, and kind of what the pros and cons of each strategy is. And at the very end, we'll open this up for Q&A with some examples at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I understand the fundamental difference between buying versus selling options. These two strategies are quite different in nature, both in terms of the rights and obligations that you have as a buyer versus seller of an option, but more importantly, the risk profile is completely different. It's important that you don't think of them as somewhat interchangeable, because they are not quite interchangeable. It's really important that you understand the nuances and the differences between buying versus selling options. So, for those of you that are brand new to OptionsPlay, you might be asking, are these sessions recorded? Can I get access to the slides? And the answer is yes. If you are a member or if you have a free trial to OptionsPlay, you are getting both the slides and the recording immediately after today's session. Now, if you don't have an OptionsPlay account, if you don't have a free trial, you can sign up at optionsplay.com/signup. Or if you have a phone, point your phone to that QR code. It takes literally 10 seconds to sign up for a free trial, and that will give you access to the recording and the slides so that you don't necessarily have to sit there scribbling notes during the session to try to keep up, and you can focus your attention on listening during today's session and know that you'll get the recording and the slides afterwards so that you can take the time to review it and go back and make sure you understand everything before you move on to the next session, which is next Thursday. But it will also give you access to the OptionsPlay platform. I'm going to show you how you can use the platform to structure the trades that I'm going to show you during today's session. So not only can you apply it to the ideas that I'm going to show you today, but for any stock that you are looking for bullish or bearish strategies, you can use the platform to instantly scan the market for opportunities and set up the same trade structures that I'm going to show you during today's session. So like I said, sign up for free at optionsplay.com/sign up, or point your phone to the QR code on your screens. It takes 10 seconds to sign up for that free trial, and that will give you access to the recording, the slides, and the overall platform. And thank you, Philip, for posting that link into the chat window as well. You can click on that link in the chat window if you want to sign up for that free trial. Now, before we move on, I do want to get a poll here launched. What is the most frequent number of legs that you trade with options? I want to get a sense for how many of you are trading single leg options, multi-leg options, and if you're trading multi-leg options, how many legs are you generally trading? And if you have no idea what that question means, feel free to answer, I'm not sure. Okay, so with over nearly 2/3 of you answering, a quarter of you, 25% of you say that you trade a single leg. And that's all we're going to go through today is single leg option strategies. 63% of you say that you trade two legs. That's what we're going to cover in session 2. And then 7% of you say 3 to 4 legs. That's what we're going to cover in session 3. So that's what I mean in terms of this trading summit is for everyone. Whether you're starting out with the single leg, you're trading 2 to 3 legs, or 2 legs, or 3 to 4 legs, there's something for you during today's session. And it's a progression to go from single leg to 2 legs to 3 to 4 legs. And you have to understand what you get with each progression as you get more complicated. What benefits do you get? And are there any trade-offs with those benefits? Now, in order to truly understand that progression, you got to understand the fundamentals, and that's what we're going to discuss during today's session, okay? So that gives me a pretty good understanding that most of you are sort of in that middle category of 2 legs. Some of you are still in single legs, so hopefully today and next week, we'll show you how the benefits that you get as you go into more complicated strategies, and then we'll talk a little bit about 3 to 4 legs and kind of what that gets you when you do venture into the deep end of the pool with regards to options trading. So let's start off by talking about equity trading, because most of you here have at least some, whether you're brand new to options trading or just starting out, you probably have some familiarity with equities trading or stock trading. And the most important thing to remember with stock trading is that you have what we call symmetrical exposure. What that means is that if you buy a stock, how much you make is completely symmetrical to how much you have to risk. If you buy 100 shares of the stock and the stock goes up by $1, What you make in that scenario is exactly the opposite if it goes down by $1. It's symmetrical in terms of how much you can make versus how much you can risk. And you get immediate gains if the directional view that you have is correct, meaning if you buy a stock and it goes up even by a penny, you start making money. If it declines by even a penny, you start losing money. And there are no time horizons, meaning as long as you have enough capital or margin to hold on to the trade, you can hang on to that trade for a few seconds, a few minutes, a few years if you want to. You can hang on to that for as long as you want. There's only one limitation that you have with equity trading, which is the fact that if a stock moves sideways, there's really no way to be able to profit from that, with the exception of potentially income that you generate from the dividends of owning that stock. But you cannot have any capital appreciation or gains on the underlying stock if the stock moves sideways. So this is pretty straightforward, I think, for most investors. Please type 1 into the chat window if that makes sense to you. And the most important thing to remember is that when you're trading stocks, you have what we call symmetrical exposure. Now, as we get into options trading, the most important thing to remember is that when you're trading options, you have what we call asymmetrical exposure. We're going to talk about what asymmetrical exposure means. But before we get into that, let's break down the 4 core essential strategies, or the foundations of all option strategies. You have calls, you have puts, and you can either buy a call or sell a call, or you can buy a put or sell a put, which means that you have 4 possible strategies when you're trading an option strategy. Now, whether you're buying or selling a call or a put, what it determines is to whether you have the right to, which is when you're buying, or the obligation to do something when you're a seller of a call or a put. And a call is always going to be the right to buy if you're buying, and then the put is always going to be the right to sell. And the question for a lot of traders is, what is the obligation or right to buy or sell of? It is for a specific underlying security, a stock, ETF, index, or currency that's determined by the symbol of the option contract. And it also has an on or before an expiration date at agreed upon price, or what we refer to as the strike price, meaning every option contract has these terms that are within the contract, and the contract determines, and the terms dictate the price of, or rather the value of the contract as the price of the stock changes, and as time goes on, as you approach expiration date. These are all factors that factor into the value of the contract, and you're effectively speculating as to whether the value of a contract is going to rise in the future or decline in the future. The same way you do with an underlying stock, you're trying to do the same thing with an options contract. Now, for those of you that are new to options contracts, you might be, or rather, it might be a little confusing as to, calls, puts, buying and selling calls and puts, which one is which. There's a little trick that I found over the years that is really helpful for, especially if you're a beginner, to remember kind of what strategy is for what. And usually we think of calls as positive and puts as negative. And then you can think of buying as a positive and selling as a negative. And if you simply multiply the positives and positives, the sign that you end up with tells you whether it's a bullish or bearish strategy. So if you multiply a positive and a positive, you get another positive number that tells you a long call is a bullish strategy. If you multiply a positive, meaning buying a put, a positive and a negative, you get a negative. That tells you a long put is a bearish strategy. Vice versa, if you sell a call, that's a negative and a positive. That also gives you a negative. So a short call is a bearish strategy. And lastly, if you were to sell a put, that's a negative and a negative, which gives you a positive. That's a bullish strategy. That's one way to, or sort of a trick that you can do to remember out of the 4 core strategies, which ones are bullish, which ones are bearish. But there's a little bit of nuance to that, and we're going to dive into that. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And like I said, there's a lot of nuance into bullish and bearish across these 4 strategies. So we're going to dive into it. But like I said, the most important thing to remember is that stock trading is symmetrical in terms of risk. options trading is asymmetrical in terms of risk. So let's dive into what that actually means. I'm going to use a stock, Freeport-McMoRan. This is a stock that's recently been in our daily plays. It's a stock that is top of mind for many of our members. So I'm going to use this, and it's a good example because it's a stock that isn't particularly trending in one direction or another at the moment, right? Meaning you could potentially look at the stock and have a bullish view, or you can potentially look at the stock and say, no, I have a bearish view. And I specifically tried to pick a stock that's sort of in the middle, and you could potentially go both ways. And we're going to explore all different strategies for bullish and bearish views for this particular stock. So the first one we're going to cover is a long call option, which we remembered as is a bullish strategy. Now, if you were bullish on the stock and you bought the stock, remember that has symmetrical exposure. If the stock goes up by $1, you make $1. If it goes down by $1, you lose $1. But when you buy a call option, you have what we call asymmetrical risk. What that means is that if the stock moves higher, you make more and more money. From that perspective, it looks very similar to a stock. But if the stock was to decline in value, you have limited risk. So instead of looking like this for a stock position, it looks like that, meaning if the stock keeps going lower and lower and lower, there's only a certain amount of risk that you can take. No matter what happens, if it keeps moving lower and lower and lower, you cannot lose any more money than that. Now, there is a trade-off with this, and we'll talk about what that trade-off is. But the most important thing to remember with the call option is that you have this asymmetrical risk profile. And that's what's attractive for a lot of investors when they first learn about call options. Who doesn't want unlimited gains to the upside with limited losses to the downside when you're wrong? And let's review kind of what that looks like. So I'm going to go out to November in this particular case. I'm using the November $40 call option when Freeport-McMoRan is trading just a little over $40, and I put these slides together after yesterday's close. So the stock was trading around $40. I'm going to buy an at-the-money call option for $40 call option, which gives me the right to buy the stock at $40 between now and the November expiration. Now, I have to pay a premium for this. I have to pay a fee in order to have the right to buy the stock at the November expiration for $40. And I'm paying $2.97 for this particular fee. And remember, each contract refers to 100 shares. So $2.97 per share multiplied by 100 means that I have to lay out $297 in cash to buy this call option. That's the most I can risk. So when I refer to limited risk, what I'm risking here is the amount of cash that I have to pay to buy that call option. What I get for that is unlimited upward potential. So if the stock really takes off, the higher it goes, the more money I can make because I have a fixed cost to be able to buy the stock. If I can buy it at $40 and the stock is trading at $50 by November, I make a profit on the difference between those two numbers minus what I've paid for the options contract. But if it's trading at $100, I still only have to pay $40 for the shares because I'm locked into that price from my contract. So the higher the stock goes, the more profit I can potentially make. That's the unlimited risk profile that I get with that call option. And the important number to remember here is the break-even price. Because I had to lay out cash to buy this premium, I'm paying $2.97 per share, and the cost at which I'm allowed to buy the shares at is $40. My break-even price is $42.97. And this is a really, really important element to understand if you're considering buying a call option on any given stock. Now, in order to understand what that really means, we'll look at a price chart here. This is the same chart of Freeport-McMoRan blown up to full screen. Now remember, let's say in this particular example, I'm bullish on Freeport-McMoRan and I look at buying a call option. The thing you have to remember is that my break-even price is this red dotted line up here. And what that means is that even though I'm bullish on Freeport-McMoRan, if the stock rallies between now and that November expiration date, but it doesn't reach my break-even price, I'm actually not going to be profitable because I have not exceeded my break-even price. Only if I was able to exceed that $42.97 am I going to be profitable. So to call a long call option a bullish strategy, in my opinion, is not 100% accurate, because a bullish position, in my opinion, means that if the stock goes up, I make money. But that's not entirely true with the call option. You have to understand that with every call option, it's not just saying that the stock is going to move higher and I'll be profitable. You have to look at what's the break-even price of the call option that I'm buying, and that's going to help you determine whether or not it makes sense to buy that call option, because I have to believe the stock is going to be above that price by the expiration date before it makes sense for me to buy that call option. So bullish, in my opinion, is not an accurate enough statement for a call option. It has to be bullish by a certain amount, and that amount has to do with how far the stock needs to move in order for you to be profitable. And that's the first almost critical lesson that you have to learn when you're thinking about buying any type of options, is what's the break-even price, and do I think the stock can make a move beyond that break-even price in order for it to make sense for me to buy that call option. Does that make sense, everyone? Please type 1 into the chat window if this part makes sense for you. Perfect. So next time you're bullish on a stock and you think, oh, let me go buy a call option, just take a pause, look at the break-even price, look at how far does the stock need to go in order for you to be profitable. Sometimes call options are relatively cheap. Maybe the break-even price is down here, and you might say to yourself, I think that's a reasonable target. I think it'll be above that level. Sometimes options might be more expensive. So if you have to pay more for that call option and the break-even price is higher, you have an even bigger hurdle to overcome before you are profitable. So you really have to ask yourself, not only do I think the stock is bullish, but do I think the stock is going to be able to exceed the hurdle of the call option by which I'm paying for that call option? And taking a look at where that break-even price is on the chart helps you make a determination. In this particular case, as you can see, this break-even price is below the recent highs here, which was just shy of $45. So maybe I can think that this is going to at least reach $45 or even higher. That might justify buying that call option. But this is really where you can turn to the OptionsPlay platform, because not only can you look at what is the most up-to-date information. So Freeport-McMoran has pulled back a little further here today. So I'm actually looking at the $39 call options. And as you can see, the break-even price on that is $42.15. But not only am I able to see this type of information and plot it on my chart to see, do I think the stock's going to go above $42.15? I can also say, well, what happens if the stock goes up to $45? How much money can I potentially make? As you can see here, I can make about a 90% return on my capital, which in this particular case is pretty good and probably worth my while. But maybe you're not as bullish. Maybe you think the stock's only going to go to 42.5. And then you see to yourself, you're only going to make an 11% return. Well, maybe that's not worth your while. And the only way to determine that is to actually use a tool like OptionsPlay that can help you calculate these numbers and very quickly, so that you can determine whether buying a call option in this particular scenario makes sense for you. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And the only thing you have to do when you're using OptionsPlay is type in the symbol of the stock that you're looking for. You can either select I'm bullish and see the 3 bullish strategies like I'm doing here with Apple. And later I'm going to show you how to look at bearish strategies. But for now, we're going to focus on bullish strategies. And when you're looking at single leg strategies, you only have to look at this middle panel. It's always going to select for you the optimal single leg strategy, how much it costs. You can see what the break-even price of that strategy is. And then you can always use the P&L simulator to say, well, what happens if the stock reaches a specific price? Let's say you think Apple's going to resume back up to the all-time highs around 196. Well, if it does happen, how much potential return do I have? Or what if it only gets up to 190? How much potential return I have? And that's going to allow you to understand how much potential return you have, versus how much you're risking to determine whether it's a trade that you want to trade or not using the OptionsPlay platform. So that helps you understand a long call. Let's now look at a short put, which is bucketed into the bullish strategies. But like I said, just like how the long call is not bullish, in my opinion, is not the fully accurate description, to call a short put bullish is also, in my opinion, not fully accurate. I think a more accurate description for it is not bearish. I'm going to show you why. So selling a put option. When do you want to sell a put option? We're going to show you the chart that's going to help you make that very crystal clear. But let's kind of determine what you get and what you are risking when you sell a short put. So Freeport McMoran, like I said earlier, when I was looking at this yesterday, when I was putting together these slides, was trading around a little over $40. So I was looking at selling the November $40 put. And for that, I can collect $2.22. So remember, for every 100 shares, $2.22 per share multiplied by 100 means that instead of paying over $2 for a call option, here when I'm selling a put, I'm going to get paid, right? Because as an option seller, I have the obligation, and remember, for a short put, I have the obligation to buy the stock at the strike price on or before the expiration date. So when I sell a put, I'm basically taking on the obligation to buy the stock at $40. And for that, I'm going to receive $2.22 per share. And I just want to put that into context. If you were to own Freeport McMoran, you will earn 30 cents 30 cents per share in dividends per year. So if you own one share of Freeport McMoran at $40 a share, you're going to get 30 cents in income for the year. Here, you're getting $2.22. That's nearly 8 times the annual dividend yield that you're collecting in this particular case in roughly 71 days. So in about 2 months' time, you're earning 8 times the dividend yield. Just think about that a little bit when you think about how much income you're actually receiving, when you think about the obligation. And the only thing that you have to do is you have to buy the stock at $40. But in order to take on that obligation, you're getting paid 8 times the dividend yield in about 1/6 of the time. That's how much income you get. Because $2.22 may not sound like a whole lot on a $40 stock, but when you put it in yield percentages, you realize it's substantially higher than what you can get in income almost anywhere else in the market. And that's why selling option strategies is actually one of the most popular strategies amongst institutional investors, because when they're managing large amounts of capital, $2.22 across hundreds of thousands of shares, millions of shares adds up to a huge amount of income. Okay. So, but let's talk a little bit about kind of what the risk profile looks like, because this type of trade scares off a lot of retail investors. You look at this and you say, I can make a max reward of $2.22 and I'm risking $37.78. That sounds like a terrible amount of money to risk for $2.22 of potential reward. And on paper, that sounds absolutely terrible. And I think this is why a lot of traders shy away from this strategy. But let's walk through and what that means, because in order to actually lose $37.78 on this particular stock, this stock has to go to zero in order for that to happen. You have to ask yourself, do you think that the risk of that is high? In some stocks, that risk might be high, and maybe you're not willing to take on that risk. But for other stocks where you feel that you are confident in the valuation of the stock or confident in the stock, and you're willing to take on the risk of that going to zero is very unlikely, and receiving the amount of income that you can get on these types of strategies makes sense to you, then let's take a look at this, because the break-even price on a short put is the $40 strike price minus the $2.22, because you're collecting the premium this time, right? You're getting paid that premium. So you're basically giving yourself a buffer on when the strategy is profitable. So now the break-even price on this bullet strategy is $37.78. Before the call option, the break-even price was above the current price. Now your break-even price is below the current price. And what that means is that if you are right on this particular trade, you make your $2.22 per share in 71 days. If the trade goes absolutely nowhere, meaning the stock goes sideways, you still make $2.22 on this particular trade. Even if the stock declines in value, you can still be profitable on this trade. As long as it stays above that $37.78, you'll be profitable, which is why to call a short put a bullish strategy, in my opinion, isn't entirely accurate. As long as you're not bearish on a stock, you can sell put options. And I can certainly tell you, you're going to have a lot more stocks that you can say, I'm not really bearish on the stock. Then you're going to be able to say that I think the stock is going to make a big enough move in order for me to exceed the break-even price and be profitable. And that's why when you think about these two strategies, when you're bullish, you're going to have far more opportunities, in my opinion, to sell a short put than you are going to be able to buy a long call, because that long call requires you to believe the stock is going to make a big and fast move in a short amount of time in order for that strategy to be profitable, versus if you sell a put option, if the stock goes higher, it goes sideways, it moves even a little lower, you'll be profitable. You're going to find yourself in a position where you're going to believe that the outlook of a stock looks like this far more often than you think the outlook of when you think the stock is going to make a big fast move in a short run. It's really not very often you believe in that particular scenario. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. So that's really the fundamental difference between buying versus selling options. As you can see, they're very, very different from each other. And it's really important for you to understand the differences between these two, because every other complex strategy you're going to trade, 2, 3, 4 leg strategies, there's what we call a strategy driver. Meaning if you're trading a 2-leg strategy, there's one of those 2 legs that's going to be the primary driver of that strategy. And that primary driver will either be a long call option or a short put option in a bullish multi-leg trade. So if you want to trade a bullish multi-leg trade, whether it's a debit spread, a credit spread, a butterfly, a condor, they all are driven off of a single leg. And it's important you understand the characteristics of that single leg, because as you trade 2 to 3 legs, all you're doing is improving upon this a little bit, right? Whether you're reducing the risk a little bit, whether you're increasing your potential returns a little bit, all you're doing is basically improving it a little bit. But the strategy driver is going to be the same. And that's why it's so important to understand the differences between buying an option and selling an option. Okay, so moving on, long put. Now, if you understood the long call and short put option, then the long put and the short call option are going to be really easy to understand, because they're just mirror images of it. That's it, right? A long put is very similar to a long call, because a long put is the right to sell the stock at a specific price. But just like a long call, you have to pay for that right to sell. So if you want to be able to lock in a price that you're going to be able to sell Freeport-McMoRan because you think the stock is going to drop in the value in some time in the future, and you want to make sure that you lock in a price that you can sell the stock at, well, great. The long put gives you that some asymmetrical exposure where you have potential to make as much money as possible all the way down to 0 in exchange for limited losses if the stock increases in value. That risk to reward ratio can be yours as long as you pay the premium for that put. In this particular case, $2.75. And sorry, these two numbers are actually reversed. The $2.75 is the max. Oh, no, I'm sorry. $2.75 is the max risk, and the max reward here is $38.25. You basically make $38.25 per share if the stock is at 0. And your break-even price is the $41 strike price that you bought the put option at, minus the $2.75 that you paid for the put option, which gives you a break-even price of $38.25, which means that if you have a bearish view on Freeport-McMoRan, you buy that put option. not only do you have to believe the stock is going to move lower, you have to believe it's going to move lower below your break-even price of that $38.25, or what was it? $38.25. It has to move lower below that level in order for you to be profitable. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And like I said, there are some times where you do believe a stock is going to make a big move in a short amount of time. Earnings season, product releases, economic releases. For something like Freeport-McMoRan, shifts in global demand of precious metals and industrial metals. Those are types of things that could drive a quick, fast move in the underlying security. And in those particular cases, buying a put option makes sense because you have limited risk and you have a lot of potential reward if you get the directional view correct. But you also have many scenarios where you can get the directional view correct and still lose money on the trade. And if anyone can relate to that, please type 4 into the chat window if you can relate to that, where you bought a call or a put, the stock moved in the direction that you expected to, and you still lost money on that trade. And it comes down to the fact that just because you're bearish is not a good enough reason to go out there and buy a put option. You have to take the time to look at the stock, click on, if you're using OptionsPlay, click on bearish, look at the put option that's being suggested, and make sure you understand the break-even price. So if I were to buy a put option here on Apple, which you might be looking at the market today, and you might say to yourself, I think that there's more downside here at Apple. Let me go out there and buy a put option. And you see that the break-even price is 170.80, and you realize 170.80 is all the way down here, and you think to yourself, well, I really only think Apple's only going to get down to about that 170 level, so that even if it does get to 170, how much money can I potentially make? The answer is that you're only going to make a 21% return. So that means that perhaps buying a put option here in Apple isn't the best strategy to go about doing it. And whether it's because you're already a little bit late to the party, right? It's already had a pretty big sell-off, or the fact that it's sold off so heavily, options are more expensive, so you have to pay more for that option. There are various reasons that might contribute as to why now is not the right time to buy a put option here in Apple. But if, let's say, you think that the downside is significantly more, maybe you think it's going to get into the 160s or the 155s, then you can plug that into the thing and see that you can make a 200% return. Maybe you are very bearish on Apple. And if that's the case, buying this put option seems like a very good opportunity to take advantage of that very bearish view that you have. But if you have a very mildly bearish view, the P&L simulator can help you easily determine whether that put option makes sense for you or not. Okay, so let's use that final example here. Let's say you're bearish, and instead of buying a put option, you sell a call option. Remember, whenever you're selling an option, the asymmetrical risk reward is still there. It's just working in the other direction. So meaning how much you can potentially make is limited, and how much money you can potentially lose is unlimited. And it's truly unlimited in a short call, because a short call has the same downside risk as being short the stock. And we all have seen what happened with GameStop and those types of names. If you are short the stock, the amount of money you can potentially lose is unlimited. So when you take a short call, this is really one of the strategies. What we're doing here is teaching you the fundamentals. I don't ever recommend that you outright short a naked call. We're going to discuss in next week's session what you can do to this short call so that you get a similar risk profile without all of the risk. But it's important for you to understand the fundamental strategy driver of a short call and what that means for your multi-leg strategies before you can trade those strategies. So when you short a call option, your risk is truly unlimited, and your max reward here is $2.42. And again, $2.42 doesn't sound like a lot, but again, put that into the context of the fact that if you own the stock, you're getting paid 30 cents a year, or you're getting paid nearly, in this particular case, 8 times that, a little bit more than 8 times that now, in just 71 days. So the amount of yield that you're getting on these types of strategies is quite high. And just like the short put, a short call has a break-even price that's actually above the current price for a bearish strategy. So what that means is that if you get the bearish view correct, you keep your $2.42, the stock doesn't move at all, you still keep the $2.42. Even if the stock starts to move higher, you have a very significant buffer against that move higher from the premium that you collect on that short call. So that even if the stock moves up a couple of bucks, you'll still be profitable. Only if the stock moves significantly against you do you become unprofitable. And even in this particular scenario, right? And I'll go back to Freeport McMoran here for 1 second, and I'll look at selling that $41 call option just to, or rather, let's adjust these prices based on the current price. So instead of selling the 41, let's say I sell the $40 call option because Freeport McMoran has moved lower here. One of the things that you'll notice with this, the break-even price of $42.59, is that when you use the P&L simulator, even if you simulate some of the adverse moves, right? Let's say the stock moves up to $45. As you can see, your losses are $241. So what you're losing is roughly how much money you can potentially make. The unlimited risk part of this sounds scary, but you really have to look at what is a reasonable move for the underlying stock and say, well, within that reasonable range, how much am I really risking? Because that risk number, like I said, is scary when you look at it. But what you should be really looking at is how much money can you really lose based on, if the stock does move higher, because that's going to give you a much better sense for how much you can potentially make versus how much you can potentially lose. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay. So, that is the fundamentals of buying versus selling options. Like I said, a lot of times I get the question, from traders, what's better, buying or selling options? And I always say, there's no right answer. It depends on what your views are in the market. When you think the stock's going to make a big move, you're generally better off buying an option because you're going to be able to get that asymmetrical risk reward ratio working in your favor. That's really kind of when you hit these big home runs, right? You look at options traders that make 200-300% returns on their trade. You can only do that when you're buying options. But the rest of the time, when you don't think the stock's going to make a big move, you're probably better off selling an option, because if the stock moves in the direction you expect it to, you get a nice yield. And even the stock doesn't, if the stock moves in the direction you expect it to, you get the full profit. If the stock doesn't move in the direction you expect it to, you likely still earn quite a bit of yield that, outpaces what you can earn in dividends or income anywhere else by a substantial margin. And that's why I would say that, you probably end up selling options more often than you buy. But then the ones that you do buy are the ones where you think the stock's going to make a big move. Okay. So just to kind of review what we discussed here today, this is kind of a cheat sheet. We'll send out these slides so that you can have this cheat sheet. You can print it out, this one page. But bullish strategies are when you expect the underlying to make a big, expect the underlying to rally. Bearish strategies when you expect the underlying to decline. And under bullish strategy, you can buy calls, but it requires a large rally in order to be profitable. But it does come with limited risk and a lower probability of profit. On the other hand, if you were to sell a put, it's a forgiving bullish strategy, and it has a much higher potential for risk. On the bearish side, buying puts requires a large decline in order to be profitable with a low probability of profit and limited risk, and selling calls is a forgiving bearish strategy that has unlimited potential risk. So out of these strategies, which ones do I trade? I will buy calls quite often, I will buy puts quite often, and I will sell puts very often. What I do not recommend ever is to sell calls, especially naked calls. But there will be scenarios where you have a bearish view on a stock, but that's what we're going to cover next week. What adjustments can you make to these strategies that can improve your odds of success when you're buying puts and buying calls, And what can you do so that you can actually sell calls, but do so without this unlimited potential risk part, right? How can you get the forgiving bear strategy without the unlimited risk potential? That's kind of what 2-leg strategies provide you with, and 3 and 4 legs to some degree even further. But we'll talk about kind of what you get with those, what benefits do you get with it, what trade-offs comes with it. We're going to learn all of that here in the next 3 weeks. But really, the goal here is to make sure that you understand the fundamentals, make sure you understand the foundations, because the foundations are what you need in order to successfully trade the multi-leg strategies, which is predominantly where you should be trading more of. You should be trading minimum 2 legs in most scenarios. There are some scenarios where it still makes sense to trade single legs, but the distribution of 25% of you say that you trade single legs, 60 or so percent of you trade multi legs. That's the right distribution in your own trading, right? About 20-30% of your trades should probably be in single legs, but the majority of your trades should probably be in 2 legs, sometimes 3-leg trades in certain scenarios. But that should be the largest distribution. In order to trade those 2 to 3-leg trades, you really have to understand these fundamentals well, so that you can deploy those 2-leg and 3-leg strategies correctly, or rather in the right scenarios. Okay. So what you'll learn next over the next few weeks, next week, we're going to talk about leveling up from singles to doubles. This week, we talked about singles, single leg strategies, understanding the fundamentals. Next week, we're going to graduate to doubles, how you can maximize return and income using debit and credit spreads. We'll also talk about managing these types of strategies. A lot of questions over the past couple of weeks regarding what are the rules for managing debit and credit spreads. We're going to cover that next week. The following, we're going to get that even more complicated into 3 to 4 leg strategies, how that can maximize returns and income with butterflies and condors. But I really want to stress the trade-offs that you get when you get into really complex strategies like 3 to 4 legs. And then the last week, we're going to talk about growing your trading account with options, how you can take everything you've learned and develop a robust trading strategy, and the emotional resilience required to be successful in trading. Because all of this does not matter if you are not able to apply it to a strategy that helps you grow your overall account, which is why my goal here is not just to teach you these option strategies. These option strategies are really important. You need to understand it. But if you don't understand it in the context of how can it make you a successful trader, I would say that, we haven't done our job. So the most important part, I would say, is this last session, how to piece it all together so that you have a shot at being successful in your trading. How can you become a profitable trader? And that part has to do with your emotional resilience, your ability to stick to a trading plan, develop a trading plan, and stick to that trading plan. What does it take in order to do that? We're going to cover that in the last session, because you need that in order to be profitable. And if you're not profitable, you're not going to continue trading options. And that's my goal, is to make sure that you have that resilience to be able to continue trading options. And with that, just a reminder, if you want access to today's recording and slides, sign up for a free trial. If you don't already have access to your free trial or a membership, you can sign up at optionsplay.com/sign-up. I will open this up for Q&A, but I'll leave the screen up for those of you that don't have a free trial to sign up for your free trial, so that you can get access to the platform I showed you, so that you can find these trading strategies, calculate your P&Ls, know exactly what type of strategies you might want to trade, and access the recording and slides. With that, let's jump into the Q&A session. There is both a chat window and a Q&A window. If you have any questions, type your questions in the Q&A window. I'll pull questions out of there. And let's take a look at the questions that have already been asked here so far. All right, how many positions a day should I open? Let's talk about how many open positions you should have at once, rather than how many should you open in one day. We generally stick to that 2% rule, meaning no single position, unless it's worked already in our favor and we're adding to that position, should risk more than 2% of your total account value. And I tend to find the limit at the number of open positions I can have at once is usually about 10. If you look at the daily play portfolio, which is what we trade, which is our example of how you should consider trading ideas that you have in the market, you'll see that the daily play portfolio probably averages 7 to 8 open positions at once, but it probably tops out at around 10, maybe 11 maximum. And I think that for most retail traders, that's a reasonable maximum number of open positions that you can have at once. How do you know whether you are bullish or bearish? You use the same chart of the stock. So generally speaking, you use a combination of charts and your fundamental understanding of the company. Fundamentals and technicals are a big part of my, I would say, playbook to determine whether I think the stock's going to be bullish or bearish. You can also use our sentiment and relative strength indicators. So Freeport-McMoRan, 1 month is neutral, 6 month is neutral, relative strength is 5 out of 10. A very neutral stock could move in one direction or another. But let's take a look at some other stocks here. Let's look at Alcoa. Notice how our trade ideas are color coded, right? So as you can see, you have the strength that tells you the relative strength of a stock, and then you have the color coding. So if I look at Alcoa, you see that the 1 month and 6 month trends are neutral to bearish, and the relative strength is 2 out of 10. This certainly would lead me to believe more of a bearish tone here to a stock like Alcoa. Or if I look at SIVO markets, as you can see, I see a strength of 10, one of the strongest stocks in the market. 1 month and 6 month trends are bullish. That leads me to be have a more bullish view on the underlying stock. And you can do it across anything in your watch list. You can do it on anything in the trade ideas section. You have the same color coding and the strength. You can look at the sectors and see which sectors are the strongest sectors that are trending higher. What are some of the weakest sectors that are trending lower? This can all be done on the OptionsPlay platform. It's all color coded for you so that you can gain that directional view from the OptionsPlay platform. Can't you make a percentage of the premium as the stock moves up? Yes, you can. So the question is, if you buy a call option and it doesn't reach your break-even price, can't you still make a return just as the stock moves up? And the answer is yes. And that is another element to consider. I was trying to keep things a little bit straightforward and simple for now, just talking about between now and expiration. But yes, you're absolutely right. Since I'm only allowed to trade single legs, can I put a multi-leg separately and have same results? In theory, you can, Elaine. It is much harder to do because you have execution risk where you intend on getting into a multi-leg, but let's say the second leg never gets filled. So you are stuck with one leg. Or if you're trying to exit a multi-leg, you have some troubles there because if you're only allowed single leg, then you have to exit the short leg first before you can exit the long leg. And maybe you have some trouble exiting that short leg and you can't get out of the strategy. You got some risk there. Elaine, I think that if you can only trade single leg, I encourage you to explore a broker dealer that offers multi-leg trading so that you can do it in a single leg. You can do it in a single order. Did I hear you that you don't recommend selling a call? Does that include a cover call? No, a cover call is a covered strategy. So when I was saying don't sell a call option, I'm saying don't sell a naked call. That's when you're selling a call option without owning the stock. Here, when a cover call, you own the stock, so you're covered in that particular case. So that is absolutely fine. Yeah, so I saw multiple questions asking the same question, and the answer is yes. Cover calls are totally fine. Naked calls, do not sell naked calls. Peter, we're here every single week to teach you about the platform, teach you about option strategies, teach you about technical analysis, teach you about building a trading strategy so that you become a resilient and successful trader. We are here every single week to do this for you. If you become an OptionsPlay member, you get access to the platform, you get access to the recordings every single week, the slides, that you can build your knowledge base. I've been doing this for nearly 7 years here at OptionsPlay, and I've been doing this for a total of nearly 18 years in my career. But we are here every single Thursday throughout the year. Will you be covering how to place a stop loss order on a multi-leg trade? So Richard, placing a stop loss order on a multi-leg trade is very, very broker specific. So I usually don't have, I do have a video on Thinkorswim on our YouTube channel on how to place those stop loss orders on Thinkorswim. But it's very broker specific. So that's why I usually don't cover that. I think that that's a question that's better suited for your broker dealer, meaning simply go to your broker and ask them, I want to sell this, I want to place a stop loss or a take profit on a spread trade. How do I go about doing that? Have them walk you through it because they would be best in being able to show you how to do that. Will you be discussing at what delta or strike price for buying or selling options? Yes, we will be diving into that as we talk about these multi-leg strategies. What are the optimal deltas and expiration dates for each one of these strategies? In a long call or put scenario, if it doesn't go up or down to break even, couldn't one get some profit by exercising the option of buying, sell the underlying stock? You can still have profit, right? So it's not to say that you can't have profit if the stock doesn't reach your break-even price. You absolutely can, but that only happens prior to expiration. But that doesn't take away from the fact that when you buy a long call or put, you still need to have a fairly quick, fast move in the direction you expect it to in order to gain that profit even prior to expiration. So it doesn't take away from the sentiment of the strategy. It just means that you have various ways to make a profit, but it doesn't take away from the fact that you need to have a quick and fast move whenever you're buying an option to be profitable versus when you're selling options. You just need time and you just need to have the stock not move severely against you in order to be profitable. Pradeep, yes, your question about 8 positions at 2 times, that is correct. What broker service do you recommend? I guess that depends on whether you're in US or Canada. In the US, I think most of the major brokers, Fidelity, Schwab, which is now TD. I trade with TD, which has been acquired by Schwab. Fidelity, E-Trade, Interactive Brokers. These are all great platforms here in the US. In Canada, I would say Interactive Brokers and Quest Trade are certainly the leaders at the moment. TD Canada also offers some multi-leg functionality, at least for US securities. Those are the 3 that I probably would recommend in Canada at the moment. I certainly would recommend a broker dealer that at the very least allows you to trade 2-leg strategies, if not more than that. What action do you take when your short put stock drops in price below your break-even price? So generally speaking, when you're selling a short put, you want it to drop below your break-even. You want it to drop below your strike price. Now, if it drops below your break-even price, the question you have to ask yourself in that scenario is, has something changed since the time that you sold the put option that has fundamentally changed your view as far as the outlook of the underlying stock? Meaning, has there been some news that comes out that has driven the stock substantially lower in price, that has changed your outlook on the underlying stock? If it has changed your view on the stock, then you should buy back the put and exit the trade, right? Because you are no longer bullish on the stock. But if, let's say, it's just a short-term volatility in the underlying stock, and now you have the opportunity to buy the stock at a lower price, that's a good thing. You now purchase the stock at the break-even price, or maybe slightly below the break-even price, and now you're waiting for the stock to appreciate in value. That's not a bad thing. So it really depends on whether you still have the same outlook on the underlying stock or not. If your outlook has changed, I do recommend you to exit the trade. If it hasn't changed, stick with it. Joseph is asking, can I cover how to repair losing trades? Joseph, I've spent a lot of time trying to teach investors to stop spending time repairing losing trades. If you have a trade that's not working in the direction you expect it to, this is kind of the difference that I see between successful traders and pretty much everyone else. Successful traders, what they do with losing trades is they cut their losers and they move on to the next trade. They spend all their energy focusing on their winning trades, because where you make the difference between profitable traders and everyone else is that profitable traders spend their time turning their winning trades or small winning trades, meaning trades where the initial views that they had were proven correct, and they basically took that and rode with it. Basically, for example, you think a stock is about to reverse its trend, you get into a small position and that trend does start to materialize. And what you do is you add to that position, and now what you can turn as a small win into a much bigger win. That's where successful traders spend their time adjusting their winners. Trades that aren't working out, they cut their losers and they move on. You can spend so much emotional energy focused on your losing trades. And, almost every single trader that I see that struggles with trading focus their emotional energy in the wrong places. They're focused on losing positions, hoping that they can turn a losing position back into a winner, but that's not what's going to make you a successful trader. And this is probably one of the most difficult things to learn, right? And for many of you that did attend my last trading summit on how to grow a trading account, this is what we spent a whole month learning. If you don't mind chiming in, just helping Joseph a little bit on kind of what you learned about that, and maybe how that's changed your view on what you should focus on and what your priorities are as a trader if you want to be a successful trader and want to be a profitable trader, is the shift in mindset that you have to make in yourself of where do you focus your attention on? Yes, you can certainly focus a lot of attention on how do I repair a losing trade, but I'll tell you, there isn't a good repair strategy. There's one very slim scenario where you can potentially turn a losing trade back into a potential winning trade without taking on any additional risk by giving away some further upside. But the amount of times where that strategy is suitable is pretty slim. And almost every other repair strategy requires you to take on more risk. And that's really where you open yourself up to turning from a small trade, small loss, into a much bigger loss. And that's how most traders struggle with ever getting to profitability, is they focus their attention in the wrong places by focusing on losers and not their winners. So Joseph, my advice to you and to everyone who probably has the same question, Joseph, you're not by any means unique in this particular case. A lot of times I get questions asking, how do I turn a losing trade back into a winner? How do I repair a losing trade? And I consistently have said over the years, if you want to be a profitable trader, don't try to repair your losing trade. The losing trade is the market telling you that your views are wrong. Stop trying to turn that around, right? Accept the fact that you're wrong. Let go of that and focus on where the market has told you that you're right, right? So when a trade is working in your favor, the market's telling you that you're right. Focus your attention on where you've been right and turn those small winners into much bigger winners. That's how you're going to get ahead. That's how you're going to be a profitable trader. And that's an incredibly difficult lesson to really wrap your head around. But when you do wrap your head around that concept, that's when you're going to make that quick light bulb is going to go over your head as to, oh, that's how I can really get ahead and start making drastic changes to my ability to become a successful trader. And many of you have maybe struggled for years to be profitable. And I know some of you have told me over the past few months how the lessons that you've learned here at OptionsPlay on showing you where you should focus your attention on has changed your outcome on trading. And if you can, please chime into the chat window and tell Joseph a little bit about kind of what you've learned and kind of how that's shifted your ability to be a profitable trader. How do I find your YouTube channel? Philip, if you don't mind posting a link to our YouTube channel, which is youtube.com/OptionsPlay, that'll be able to help you navigate to some of our videos. Are the daily play options actual recommendations or just examples? They are both. They are recommendations and they are also serving as examples. And I always, remind all of our members every single Monday, we get on a call, we discuss the market and we discuss our daily play positions. I always remind investors, our daily play trading signals, the value that you're going to get out of that is not actually in the ideas or the recommendations themselves. The value you're going to get out of it is the strategy by which we trade those recommendations. I get very I write with each recommendation that we put out, I write alongside with that what my thought process is. And exactly what I just explained to Joseph. When a trade's not going in my favor, I don't do it. There's no ifs or buts. There's no regrets. There's no excuses. If a trade doesn't work out, you cut your losses. And a lot of traders get tripped up on that. They don't want to accept the loss. But remember that not wanting to take a loss on a trade is basically kind of beating yourself up for not being able to tell the future. None of us can tell the future. Stop beating yourself up for not being able to tell the future. When the future doesn't work out the way that you expect it to, just accept it. Cut your losers. And when you cut your losers and keep them small, that's how you even have a shot at being profitable. Because most traders aren't profitable because their losses exceed the wins that they have. And it's not that their winners are too small. That certainly is one factor. Most of the time that I see traders fail to be profitable, it's because their losses are so large. Why are losses so large? One, we hold on to losers for too long because we don't want to accept the fact that we're wrong, or that we don't want to accept the fact that we're right, that we were incorrect on a thesis or a trade. And that's just, there's no other word than to say that it's just stupid, because you're basically saying that I couldn't tell the future and I'm beating myself up over it. Don't beat yourself up over the fact that you can't tell the future. Accept the loss, move on, keep your losses small. And then, on the other side, when the trade is working out in your favor, let it ride. Don't just take profits early. A lot of times I see traders, when the trade works out, they immediately take profits. Do yourself a service. Just try in that particular example, when you think you want to take profits, stop yourself from doing it. Instead of taking profits, add on to the position, because that's where the market has said that you're right. And because you're right, now you have the potential to actually ride that trend, right? You basically identified a trend correctly. Now see if you can try to ride that trend. And if you're able to do that, now you've turned a small win into a much larger win. And that's how you become a successful trader or profitable trader, is you try to hit home runs, and at the same time, you keep your losses small. You got to do both at the same time. It's not easy to do both. And what we do with the daily play is we show you a reminder of both things every single day. When we look at our portfolio, where can we take a small win and turn into a big win? Where are we losing on a trade and we're saying that we're wrong? Cut those losses immediately. Keep your losses small, and then focus on your big picture wins. If you can do that, you can become a successful trader as well. So our daily plays are both recommendations and examples as to how you should be managing your portfolio. It's a daily reminder, because what I just taught you right now, or what I just summarized right now, it's easy to understand the words. It's very difficult to implement it. So what we try to do with our daily play positions is we show you how to implement it every single day as a reminder to you as to what you should be doing, so that when you look at your own portfolio and you say, hey, I'm thinking about taking profits on this early, you have a daily reminder as to, hey, maybe I shouldn't do that. Maybe I should try something different, especially for those of you that are viewing this today and saying that I am not yet profitable, I'm figuring out how to go about doing so. This is the template as to how you go about doing so. First, Young Chi, you seem to have a problem with setting up a free trial. Please send us an email at info@optionsplay.com, and we'll try to help you out there. info@optionsplay.com. I'll put the link into the chat window so that you have that. We'll be able to help you with that. Any other questions before I sign off for today? If there are no other questions, I want to thank everyone for your time here today. Specifically want to thank the members for your support and allowing us to continue to do this. Like I said, we do this for you guys. I wouldn't be here if it wasn't for your support, and I wouldn't be here if you guys aren't finding this helpful in terms of helping you become a successful trader. That's my goal. That's what we're focused on every single week, is making sure that we continue to build your knowledge base so that you can get to that point where you are confident in your ability to successfully grow your overall account. So thank you so much, everyone, for your support and your time. And I will see you guys next Thursday, where we're going to talk about leveling up from singles to doubles. And just a reminder, if you are looking at OptionsPlay for the first time, you want to sign up for the free trial, or you want to get access to the recording and slides, optionsplay.com/sign up, or point your phone to the QR code on your screen, and that will get you there. Thank you so much. Have a great trading day.